You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it must be Friday, it must be noon central, it must be time for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Been changing a lot of things around lately, moving times, moving days. Luckily, Vol Views right where it's always been, noon central here, at least for a while now. So on Friday, so you're not missing out anything there. Everything else, OB moving up a little bit. Mondays and Thursdays, noon central. Now we got TWIFO on Thursdays now, 1:30. So things moving and shaking, but Vol Views is the constant, the one constant in your options universe. You guys know how to get it now, of course, website, mobile app, iTunes, podcast, all that kind of fun stuff. Or, of course, you can join us live via the Mixlr feed, MIXLR, if you follow us on social media, or if you've subscribed and follow us in Mixlr there, then, of course, you get notified when all this good stuff goes live. So head on over there, grab it, and you too can join us. It's fun. It's fun to join the show and let's kind of chat in live. We talk about the meatball, all sorts of good stuff here on the old program. Make sure, however you listen, live after the fact, you hit us up, questions, comments, insights. We do, yes, indeed, we do like to hear from you guys. And joining me on the old program today, we got a fun one. First off, joining us from, I believe, the Carmen Line / Option Pit Global Headquarters, the greasy meatball himself, Mr. Mark Sebastian. Mark, welcome back to the show, sir.
Hey, good to be here. Always a joy and a pleasure to be on the Views of Volatility.
Someone's got to view it, right? It might as well be us. And also joining us to help us do just that, he's an old friend, even though he hasn't been on in quite some time. Actually, I believe it's been quite some time, so we need to make up for that. He is Scott Nations. You've probably seen him on CNBC. He contributes to a lot of programs over there. He's also the creator of the VolDex and SkewDex products you guys have asked us about once or twice in the intervening years since his last appearance. He also wrote The History of the U.S. and 5 Crashes. So he's been a busy guy since the last time he's been on, but I'm glad to have him back. Scott, welcome back to the Volatility Views program.
Thanks very much, guys.
All right, and let's go to mix things around a little bit. I know, Mark, your schedule is kind of fluid today, so I think I want to do a deep dive with Scott on all things VolDex and SkewDex and everything else in a little bit. But so let's kick it off with our volatility review, so we can see exactly what's going on in the world of volatility right now.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. This is indeed the portion of the show where we do exactly that. We view what's happening in the world of volatility right now and over the course of this past week. And as we're coming into the middle of the trading session here on Friday, the 17th of August, we're seeing another kind of split, mixed day. The S&P and the Dow slightly in the green. The tech-heavy Nasdaq taking a little bit of a rest today, off nearly 0.5%. And VIX Cash also taking a bit of a rest today, off about 1/3 of a handle. Needs to move about another 0.8 of a point, and then I'll be really happy by the end of the show. But we have some time. We all know an hour is a long time in the world of volatility for it to line up with my crystal ball prediction from last week. But let's start with you, Mr. Mark. What's been on your radar? What's been lighting things up? What's been catching your eye in the world of volatility this week?
Well, we had a bit of a vol blip on Wednesday. I think people thought the turkey was the driver for Wednesday's sell-off, but really it was all about China. And then when we got the China we're going to start negotiating with them again. That sent us off to the races, and I think we're going to bump against. I wouldn't be surprised if we bump against 2860 again before all is said and done. I think we're just in kind of a technical range right here, but earnings have been great, and I think one thing to think about is what are the odds that they allow that they need this Chinese win by the middle of September for November elections. So I think you'll see some things come around in the next couple of weeks.
Yeah, it has been kind of a crazy, topsy-turvy, whipsaw-y week in the volatility space. Indeed, just in the last couple of sessions, we saw, markets selling off, VIX, VXX rally, and then kind of the opposite yesterday, the market rally, and everything kind of coming back in. So it was quite easy. There's a lot of opportunities out there for traders. Also quite easy to get whipsawed if you weren't paying attention out there. Right now, coming into showtime here, we got our VIX Cash, like I said, a little bit north of the 13 handle. Our old friend VVIX, aka the volatility of VIX, looking a little bit frothy, looking a little bit hot and heavy. 105 and a quarter coming into showtime here. So as you know, we've kind of been hovering in the kind of the low 90s, mid 80s range for a while. So 105 looking a little bit juicy, a little bit frothy out here in the world of all things volatility and indeed options. And Scott, same question for you, sir. It's been a topsy-turvy week. What has really been on your radar this week from a volatility perspective?
As an option trader, you expect for volatility to really come in during the summer, and you know what? It hasn't. We pay attention to some of our proprietary indexes. You mentioned TailDex earlier. That ticker symbol is TDEX. It measures the cost of crash protection in the S&P. It gapped higher at the end of last week and has stayed there. So even though the S&P is just barely over 1% from an all-time high, and probably closer to an all-time high if you count dividends. Crash protection is relatively expensive, and volatility in general is relatively expensive, particularly given the time of year. So I do think that there are some opportunities here, particularly once we get just a little bit more insight into the situation with China, because we are in a situation where good news read China, the S&P will be up 20 handles overnight. And if we get bad news, it's exactly the opposite. We can be down 20, 25 handles overnight without very much opportunity to react. So I think that's why implied volatility is higher than you would expect otherwise, but it also means that there are opportunities.
Yes, certainly these markets are providing naught if not opportunities. It can be intimidating sometimes to the faint of heart, especially when we're moving and shaking kind of just all over the place of late over the last few sessions. I could see how some people could just say, oh, take your ball and go home time. But these are also times with interesting opportunities. Looking out here to what's lighting it up out here on the futures side of the space, the VIX futures to be precise, we're seeing a pretty healthy curve, nothing super crazy out there. We're seeing the cash distance between the cash and the front month about a little over a half a handle, about 0.6, and we're seeing cash out to about 2 months out to a little bit shy of 2 handles, about 1.7 or so out there in that range. So nothing super crazy out there. I know, Scott, you're a big futures proponent. You talk a lot of futures over there on CNBC, and regularly you have a whole show all about that. Do the VIX futures come onto your radar a lot over there, and anything catching your eye out there of late?
You know, we don't talk about VIX futures on the show very much. That's really not the sort of thing we just discussed on Futures Now, which is the show I'm on CNBC. We're going to talk about other markets, gold, crude oil, fixed income, where the best way to get exposure is through futures. But on the volatility side, again, I do think that the interesting thing is skew. And I know you guys want to talk about skew a little bit. And
I love skew.
There are a couple of great ways to measure it. One way that we suggest people measure it is the VIX-Volley relationship, and Volley is the ticker symbol VOLI. That's the ticker symbol for VolDex. VolDex is purely at-the-money implied volatility. We know that VIX uses the entire skew, all of the out-of-the-money options listed. And so if you normalize VIX by dividing by Volley, then what you have is a more or less pure measure of skew. And so that's really interesting to look at. You can also look at our SkewDex, but that VIX-Volley relationship is relatively high right now. And so that tells you something as well. And again, maybe there's an opportunity there for people who want to trade that in sort of a defined risk way. You can take advantage of that, either using volatility products or probably better to use outright options.
Yeah, how many strikes are you actually looking at with Volley? I'm kind of interested in how you formulate that. And are you looking at, is 30 days still? Are you using main contracts? Are you using weeklies? Just kind of what are the ingredients in the milkshake that is Volley?
Sure, we do use weekly options. It is 30 days to expiration, and we use the first in the money and first out of the money put and the first in the money out of the money call. And our underlying is SPY. We think SPY options, the options on the Spider ETF, are a much better option vehicle for a volatility product. They're listed on 15 different exchanges instead of one exchange. Mm-hmm. They are much more liquid, and they have much, much, much tighter bid-ask spreads. So that's why we use SPY. But again, precisely at the money and precisely 30 days to expiration.
Interesting.
Mark,
that's fascinating. But yeah, well, whereas VIX really does use the whole curve. I mean, that's an interesting way of looking at skew, because, the SIBO has their skew index, but that updates, once every third week, and it's really difficult to use. But so, Scott, one of the things our old friend Russell Rhodes, who I'm sure you've met before, he did a big back study about skew and found that skew being steep is actually surprisingly bullish and not bearish. What are your thoughts on that? And do you see the same thing with SDEX?
That's a great question. We think that SkewDex, ticker symbol SDEX, is a much better measure of skew. For one reason, it ticks every 15 seconds during the course of the trading day. And if we measure skew the way market participants have always measured skew, much like we measure volatility through VolDex, the way participants did. The way I describe it is this. Whenever somebody would walk back into an option pit or now sits back down at the desk, they would start by saying, hey, what's the at-the-money vol? Give me the straddle. And I'll fill in the rest of it myself. I'll figure out what the calls are doing myself. I'll paint the rest of the picture myself. Nobody has ever walked into a pit or sat back down at a desk and said, please give me a strike price weighted average of every option that's listed in the front two expirations. Nobody does that. And skew is exactly the same thing. People want to compare generally the puts in the equity world. They want to compare the puts to the at-the-money volatility, and that's what SkewDex does. It's the normalized cost of a one standard deviation out of the money, 30-day to expiration put. And so that's how we measure it, because that's how practitioners have usually measured it. Now, given the way it's calculated, it tends to be really mean reverting. It's at 66 right now, which is a little high, which is about what you would expect, because right now people are more worried about some big move down, more so than, say, going in and buying a bunch of at-the-money options or a bunch of at-the-money puts. They're willing to go out of the money a little bit. So, but that's how we look at skew. That's how we measure it, along with TailDex, as opposed to the way somebody else does it.
Yeah, and I know you're working on. Getting these things listed, and so kind of my question is, the argument for VIX, and I would love to hear the counter argument, is that VIX is actually very similar to how traders that are trading variance might measure variance. What would you see as the use case for options or futures or an ETF on Volley, SDEX, and TDEX?
We have licensed VolDex to Nasdaq. I mean, that's public. We've talked about that quite a bit. The Wall Street Journal has covered that, and we're still working with Nasdaq to bring VolDex futures and options to market. As you can imagine, in this day and age, that takes a long time. So we recognize why VIX is crafted the way it is, but we created VolDex the way we did, again, focusing on at-the-money vol, because we think it's superior. Otherwise, we wouldn't have bothered. People understand at-the-money volatility, and at-the-money volatility, the way we describe it is we've deconstructed skews so that you understand exactly what the measure is telling you and what it is measuring. And so that's why we think that our suite of products are just a better measure of volatility, more understandable measure of volatility. Because, as an example, VolDex, Volley, VOLI, is up about 2.5% right now. You know exactly what that means. But VIX is up 3.1%, and you don't know what that means. Where is that coming from? Is that coming from the at-the-money? Is it coming from the puts? Is it coming from calls? There's no way to know. And so that's why we created VolDex the way we did. We just think it's a better way to look at volatility.
You know, Scott, it's interesting. Last time you were on, which I looked it up before the show, it's been almost 4 years. Hard to believe. It was your last appearance was on episode 131, all the way back on October 13th of 2014. Hard to believe, isn't it? But yeah, you came on and we talked that was kind of the early days of VolDex and SkewDex and TailDex. At the time, you had just licensed it to ISE. Obviously, ISE now part of the Nasdaq empire over there, so obviously their deal kind of went with it. At the time, I thought it was an interesting idea. You know, we have seen people come on the show for years, pitch us all different flavors of VIX. VIX plus this, VIX minus that. The notion of VIX minus skew was interesting, but I also thought, one of the interesting upgrades they had made to VIX in the recent iterations was, of course, to incorporate that skew data because it provided a little bit more context to what was going on. Of course, in recent years, it turns out that maybe wasn't the best thing for them. SEC, CFTC looking into them, a lot of allegations of things being manipulated pre, post settlement, all that kind of fun stuff. SIBO's in the middle of dealing with all of that. So I'm kind of curious, the landscape has obviously changed quite a bit over the past almost 4 years since your last appearance. I have to imagine right now, this is kind of a good time to be sitting there with a VIX minus skew product. Would you agree?
I think any time is a good time for us. Again, we think we have a better product. And the way that we measure volatility, again, is we think superior. So we're going to live or die on the quality of VolDex, not necessarily on the problems that somebody else is having. You never want people to lose money when they're trading. That may sound goofy, but trading and investing is not a zero-sum game. And so we don't want to hear that people have lost money by trading volatility products, even if it's a rival volatility product. And so to the degree that people have lost money or feel disadvantaged because of rival volatility product, that's not something that we like to hear. It's not something that makes us feel good because we believe in our product, and so to a certain degree we believe in volatility. And we want everybody to do well when they're trading volatility.
Yeah, that's kind of the other side of the coin. I was going to ask you that as well. Some people could view it the other way, that this has maybe cast a shadow on the entire vol space. VIX is the biggest dog in the yard. If they have issues, it could make people look askance at the entirety of the rest of the space. So is it more of the former, where you think it's kind of been an environment where clients and people, potential end users, are contacting you saying we're interested in a VIX-like product sans skew, or is it maybe more of the latter, where you're seeing people are maybe a little bit reticent to dive into the vol space? How is it shaping up for you right now?
We have, it's no secret that we've been on an extensive roadshow with Nasdaq. We've met with the biggest volatility players in the world, and I mean literally the biggest volatility players in the world. We've met with some of the biggest investment banks in the world and some of the biggest volatility hedge funds in the world. Everybody is desperate for a competing product. Everybody is. We had one giant investment bank say, if you launch this tomorrow, we met with them on a Monday, if you launch this tomorrow, would have been a Tuesday, we will trade it on Wednesday. So people are desperate for new volatility vehicles, and our job is to deliver them. I think everybody has learned that volatility can be a wonderful asset class. And I think that they're just looking for alternatives when it comes to the expression of those products when it comes to futures and options.
Well, I had a chance to chat with Kevin Kennedy, who heads up the options initiatives over there at Nasdaq back at the OIC conference earlier this year, and I asked him specifically about your product because we do get inquiries about it every now and then. You're right, people do like the idea of alternatives in the volatility space, and I asked him specifically. I said, is this kind of a favorable? Do you view this as a favorable environment? And he had a bit of a smirk, and he kind of said yes. So it seems like they certainly are getting behind the product. They're interested. You never know when things move into a larger exchange group if they're going to have the same level of interest that something like an ISE did. And so it's interesting to see that. I'm glad to see that they are. And it does seem like they view this as a favorable environment to launch a volatility type alternative without the skew, which is a good thing for you, Scott, because it sounds like Nasdaq's really getting behind this thing.
They are great partners. They're a great exchange. As far as we're concerned, they're the best exchange in the world, and they do have worldwide reach. And again, they've been great partners. They are fully committed. That's why I'm certain that we're going to get where we want to be. And I think, again, they recognize that this is a superior volatility product, and I think that that's why they're so firmly on board.
The one issue I know you guys encountered back with ISE, I know you're working to try to solve it at the time the deal went through with ISE and Nasdaq, was, of course, the underlying. That's kind of where a lot of these products, the rubber meets the road. What could it be? Should it be a future? Should it be an ETF? Should it be something else, an ETN? What sort of structure should it take? Where will it be listed? How's that? I know that was kind of bogging it down when we talked about 4 years ago. How's that process moving along?
Well, we are committed to launching a futures contract, and that seems to be the best way to express the underlying. So, but so much has changed. It's been a long time, but so much has changed, and we've taken that time, that opportunity to improve our outreach. And again, Nasdaq has bought ISE. They've acquired ISE, so that's been a great thing for us. ISE was a great partner. Nasdaq is a great partner with a slightly bigger reach. So again, we'll get where we're trying to go. Our goal is to make certain that issues like the final settlement procedure don't allow somebody to, well, let's put it this way, kind of put their thumb on the scale, if you will.
Yeah, I know exactly what you're talking about.
Sorry.
Go ahead, Mark. Go ahead.
Does Nasdaq have a futures exchange yet, or are they working with? Are they going to work with maybe CME or with
Nasdaq
ICE?
Nasdaq has a great futures exchange, NFX. They launched it year before last.
Okay.
So they have a great futures exchange with a sizable trade.
What's on there? What's on there?
They have a bunch of, right now they have a bunch of energy derivatives that have captured a ton of the energy futures business, and they have announced that they're going to list some treasury futures. So that have a really neat advantage over the vanilla board trade Treasury futures.
Yeah, but what about? But they don't have the NDX, which is a little funny, right?
Well, you can't. You have to understand.
I know
that situation.
There's
a licensing agreement, and I'm not speaking for Nasdaq, but there's a licensing agreement in place.
No, I know.
CME.
I get how it works,
and
right? No, totally. It's just kind of funny.
But let's make sure everybody who's listening understand
Okay.
How it works. And so there's a and again, I'm not speaking for Nasdaq, but there's a licensing agreement for that in place. And when asked about that, Nasdaq has said that that's the story. The licensing agreement is in place, and they are reviewing their alternatives when that licensing agreement expires.
There you have it, folks. I'm excited to see these futures trade because one of the things I think maybe people don't realize is there's room in the space for more than one, and actually having multiple volatility products is probably helpful to both products long term. If there are two healthy, it's not like the Eurodollar future really affected the 5-year Treasury, right? The two of them trading off each other actually made volume for both. So I would love to see a successful launch of Volley and SDEX and TDEX because I think that there's a great use case for them, and I think it would, in the end, be a great product to use versus VIX. You'd see people probably taking VIX futures versus the basket of the three, and developing trades that spread off the overpriced or underpriced parts of the volatility curve. I think there's a lot of advantages in what you're doing, and I'm licking my chops, Scott. I just got to say it.
Well, we obviously are too. First of all, we will launch VolDex first. So the plan is to launch VolDex before we launch, say, any of the others. And launching any of the others as derivative products is still a little bit up in the air. But we have often said that we expect a substantial amount of trade in the Volley versus VIX spread for the reasons I've just described, because it's a way to isolate skew, which is something you might very well want to isolate. That could be a really, really interesting trade.
Yeah, I mean, I'm just imagining a scenario where I've got a fair value calculator, and I think at the money's too cheap, and out of the money is too expensive, and I, put a three-way trade between, a VIX future, VolDex and SDEX or that skew curve. I mean, that could be a fun trade. I mean, that's what people do in the SPX itself and the SPY, right? They're trading a lot of skew, and to have if you guys figure out a way to get that thing listed, I think that will be a very fun product to trade in the mix.
Oh, I think we're definitely gonna get it listed. We're gonna get to market and for the reasons you've described, because it really offers a new basket of tools for people to use.
And Scott, you mentioned getting things listed. Is there any time frame on that? Anything our listeners can expect when they could sink their teeth into these products?
That's a great question. We would leave that up to Nasdaq to answer. I don't mean to ditch your question, but that would just be up to Nasdaq to answer.
And I know we got so excited diving right into discussion of the products. We probably should maybe dial it back really quickly here at the end for our listeners who didn't listen to the show 4 years ago we did with you. Scott, why don't you go ahead and give us a really quick overview? Obviously, you have three main products over there. We've been talking mostly on VolDex, but you have SkewDex and TailDex over there as well. Give our listeners a quick overview of all three and maybe some quick compare and contrast between them for those of listeners out there who didn't join us 4 years ago on your last appearance.
Sure. Well, again, VolDex, ticker symbol Volley, VOLI, precisely at the money implied volatility, 30 days to expiration on S&P. The underlying is SPY because those options are just much more liquid, better for a volatility product. SDEX, SkewDex SDEX measures skew in the S&P space. It's the relative cost of a one standard deviation out of the money put. And TailDex is also really interesting. We call it the cost of crash protection. TDEX is the ticker, and it measures the cost of a 3 standard deviation 30-day to expiration out of the money put, again in SPY. And so since 3 standard deviations is really considered the cusp of a tail event, it measures the cost of protecting yourself against the tail event. And right now it's at 1692. That is a relatively high reading for period, but particularly for this time of the year.
There you go, listeners. People are always looking for skew measures. We talk skew index a lot. Obviously, you can do the risk reversal math yourself, or SkewDex, another way to go, or TailDex even, to go look at that sort of stuff. And Scott, I'd be remiss if I didn't mention as well, since the last time you've been on, you sat down and actually cranked out a book, The History of the U.S. in 5 Crashes. I like that title. Tell us a little bit about the book and why you felt compelled to write it.
Well, it's actually my 3rd book. I've written a couple of technical books about option trading. Those were the first 2. And then this one is a general interest book. This is not intended to be a technical book at all. It's intended for a general audience. As a reader and as a market practitioner, it dawned on me, as in reading about past stock market crashes, that they shared an astounding number of similarities. And so as I read a little bit more, I realized, wow, this could really be interesting. So it covers the 5 modern stock market crashes, and talks about the similarities, what caused each of them, the cast of characters. Too often the characters were rogues, but what caused them. There's always some sort of external catalyst that often has nothing to do with the markets. There's always some sort of financial contraption that seems like it's novel, it's new, it's poorly understood, that causes problems. And there are other similarities that I think people will really enjoy. But
what are the 5 crashes that you put in your list, if you don't mind me asking?
Sure. No, it's a great question. The Panic of 1907, which is what really I consider the first modern stock market crash. Panic of 1907, so bad that they had to create the Federal Reserve as a result. 1929, the quintessential crash. 1987, the only crash any of us, the oldest crash any of us are going to remember, but by far the worst day the stock market's ever had. Then I talk about the 2008-2009 meltdown. That's the 4th one. And then the 5th one is a little different. That's the flash crash on May 6th of 2010. And while the market largely recovered on that day, the reason I include it is because the next crash is going to look like that. The next crash we have is going to look much more like the flash crash on May 6th of 2010 than it is on any of those other crashes, even the one in 2008 and 2009. So I think it's really instructive to know more about the flash crash, and that's why I included that.
I like this, Scott. So, if the whole NationsShares thing doesn't work out, you have a career as a budding financial historian ahead of you. I like this.
Well, I really enjoyed writing the book. I think people will love reading it, particularly if you're interested in the markets. I will say this: writing books that's a difficult way to earn a living.
Yeah, everyone I know, particularly in the financial realm, who's written a financial book, after they're done with it, they always tell me they will never do it again. And then inevitably a year or 2 later, they get sucked down the rabbit hole and they end up doing it again. And then they say the whole thing over again. I'll never do that again. That was terrible. But in the process of doing it, I imagine kind of like giving birth. When you're done with it, I'm done. Then a few years later, you forget and the bloom comes back on the rose and you do it again. So have you always been interested in kind of financial history, or is this something that's kind of been lurking in the back of your brain for a while?
I have always very much been enjoyed in history. I enjoyed reading history, and so when I got the opportunity to write the book, and everybody at William Morrow, which is an imprint of HarperCollins, when they agreed to publish the book, I was really excited, and they also have been great in helping me bring the story to a wider audience.
Well, check it out, listeners. It is indeed The History of the U.S. in 5 crashes. An interesting title for that. Scott, I could keep talking about the history stuff all day long. Bit of a history buff myself, but we have to keep rolling with our volatility review here and also answer some listener questions. So stay tuned for that, Scott, because we're going to rope you in for that as well. But before we do that right now, if listeners, I'm sure they're really interested, they're intrigued, they want to learn more about your various products at NationsShares, where should they go? What should they do?
The website is nations.com, so they can go to nations.com, or they can ask questions of me on Twitter. Twitter is a great way to have a little interaction. My Twitter handle is simple enough. It's @ScottNations.
Yep, give the man a follow @ScottNations. We'll make sure we retweet it here. We've been doing so throughout the show, so you're probably already following him, but if not, get over here and give him a follow over there. Let's keep rolling with our volatility review, and then we'll get into some of your questions in a little bit. We also, Mark, asked a poll for our audience, so they get to play along this week in the crystal ball, so we'll see how they do in a little bit as well, which should be fun. Let's dive back into our old friend, the mothership, the VIX options there. Kind of actually an active week for them, as you might imagine, given the fact that we're whipsawing all around over there. Let's see how we're lighting it up today. Today, actually not so much. Today, only about 224,000 contracts on the tape. ADV hovering right around 450,000. So kind of right in that seasonal range you would expect for right now, but off of the typical average you'd see somewhere north of 600,000 in the active periods of the year. But this week, pretty active. 633,000 contracts on Thursday, almost 1,966,000 on Wednesday, Tuesday, a little bit shy of 500,000, and one Monday, 579,000. Call the put still hovering right around that 2.9, 3-to-1 range, so pretty much unched from where it was last week. In terms of hot VIX strikes, where the action is actually lining up out there, our top 10 big positions in VIX land right now. A lot of AUG, but others are starting to creep in there as well. Number one, the AUG 20s, 207,000 contracts open there. Number two, the AUG 28s, 195,000. Number three, the SEP 20s, 190,000 open there. Our first SEP on the list. Number four, the DEES 47 halves. An intriguing strike selection. And our first DEES on the list, 166,000 there. I want to dig into that one a little bit more as well. The AUG 30s coming in. Number five, the 30 strike. Can't go a week without having a 30 strike represented somewhere in our top 10 hot strikes. Everyone's just enamored with the 30s. I don't really understand it, but that's a conversation for another day. 164,000 open there. Number six, the AUG 17s, the comparatively reasonable AUG 17s, 155,000. Number seven, our first put on the list, the AUG 13s. Very popular strike these days, 150,000 contracts open there. Number eight, the AUG 21s, 144,000. Number nine, the SEP 22s, $141. And rounding out the top 10, our second and final put on the list, the AUG 14s. Going out here to 137,000 contracts. Total of about 8.8 million contracts open. So OI starting to creep back up there. That'll come off again, obviously, but creeping up to about 8.8 million, about 6.6 on the calls, and about 2.2 million on the puts. Interesting paper going up this week. Just looking here really quickly. We have been joking about it's kind of bullish risk reversal season, seems like, in VIX options land these days. We saw a few more of those going up this week. We got the AUG 13, 18, 28 bullish risk reversal going up earlier this week here. We got the, 13 puts, paper selling those 14, almost 15,000 times for 57 cents, and then buying the 18, 28 vertical for doing that for almost $1, 96 cents there. Again, almost 15,000 times. So bullish risk reversals are active. The AUG 13 puts in general are just a hot strike. I mentioned they're in our top 10 this week, so keep an eye on the 13s out there as well. Mark, I know you said you saw some verticals going up today. Break that down for us, and what else caught your eye this week from VIX options perspective?
You know, it was amazing. This time last week, you and I were talking about the fact that I could buy anything I wanted to in VIX. They were selling me straddles. You name it. They're regretting those sales right now because vol is through the roof in the options themselves. VIX is kind of back where it was, but VVIX, since I bought those straddles, has gone from 80 to 105. So the volatility of VIX options is way up relative to where it was last week. The big trade that just went up, a customer bought 21,000 of the 18 calls, sells 21,000 of the 23 calls, sells 10,500 of the 28s, paying 29 cents. Kind of an odd one. Few other kind of big trades that have gone up. Here's kind of one, actually. I know we don't talk, speaking of SPY. SPY, DEES quarterly, two trades. The 320-330 call spread trades 10 cents, 190,000 times. Still bid.
320, 330?
Yeah, December 31st.
Okay,
and then
December.
the December 31st, 315 3/4 call spread, they paid 14 cents 100,000 times. So up to actually 220,000 times. So somebody is ultra bullish SPY right now because they're thinking it's going up another $4 just from here by the end of the year. So I thought those were both really interesting trades, along with that VIX trade that went up.
Yeah, I think that qualifies in the ultra bullish camp over there in SPY. You're right. We don't get to talk SPY, but it all fits in. Obviously, Scott's working his with SPY over there as well. Speaking of products we look at, a lot of our listeners like to pay attention to VXX. Scott, I know you're more of a futures guy and looking at the big VIX underlying. You ever get a chance to look at the realm of volatility, other ETPs out there like VXX that come on your radar on a daily basis?
Well, we pay attention to those a little bit. We're actually we break down volatility ourselves, and so we're looking at what expirations are interesting, which ones are rich, which ones are cheap, and what parts of the skew that we can deconstruct we think are really interesting. And so that's really what we're paying attention to right now, much more so than some of the retail products, which can be great products if you use them sensibly. But just given what we do in our history, we might take it another level deeper and a little bit more. We may take it to a level that's just one notch more sophisticated.
No, I fully expect that. A lot of our listeners still like to play in VXX land. As long as you know what you're getting with VXX, it can be an interesting product. That predictably crappy, I think as you called it in the past there, Mark, nature of it can work to its advantage this week. Perhaps not so much for a lot of our listeners I know who like to lean to the dark side of volatility. VXX right now hovering right around 30 1/4, which is roughly two handles, about 1.75 points higher than where it was this time last week. We were kind of in the midst of that volatility malaise over the last week and change or so. So that was a lot of you were excited about that. We were looking at VIX or VXX really heading to the downside. This week, of course, a lot of that coming back up. ADV hovering a little bit shy of 250,000 contracts, so it's been kind of an active week. And a lot of this week over that, 294,000 in VXX options on Thursday, almost 500,000, 442,000 on Wednesday, so a very active day. Tuesday, 127,000. Monday, 310,000 contracts. So interesting stuff out there. I won't make you guess this week, Mark, because you have an unerring ability to guess it. What is the number one open interest position? Spoiler alert, it's still the Jan 10 puts, listeners. 204,000 of those bad boys open right now, sitting there at a penny. You can buy all you want. For a penny, you too can play the home game out there. But interestingly enough, we did see some people trading some put love this week in VXX, a little bit higher mark than our usual 10 strike. I guess they decided the 10s were a bridge too far. Someone picking up 5,000 of the Jan 15 puts for 6 cents. Are any of these in your arsenal there, Mr. Mark? I know you love your VXX Jan puts.
Yeah, we should tell. We've got 7,000 of the 15s on the tape today as well. Looks like a customer bought 7,000 for 6 cents this morning. So there's another one. Little rich for my blood. I'm a penny trader. I did buy 1,000 more of the Jan 10s yesterday for a penny.
I gotta say, the penny bid going out. Is that you right now?
That's me. I'm bid for 500.
Whenever I see that penny bid there, I know it's you.
But why wouldn't I, right? My net cost on those is actually less than the cost of the option because C2 pays me back. So, Scott, this is my fundamental theory. I want to throw this by you and see what you think. So if you calculate the daily roll in VXX, it amounts to a decay of around 18 cents a day. So given that there's about 150 days left in the year and VXX is at 30, it is going to lose about $27 between if VIX stays around here, if we don't get another huge blow up, obviously. All other things equal. Ceteris paribus, as the Greeks used to say. Or is that Latin? That's the Romans that used to say ceteris paribus. Anyway, VXX is, I think, going to lose, somewhere between $20 between now and the end of the year. I'm buying these 10 puts for a penny, and I'm not going to carry these all the way down. But what happens to options as they get closer to the money? They start picking up value. They start picking up some vega. I think I'll get a chance to sell some of these at 10 cents, 15 cents, maybe 20, and my penny bid for 15,000 of these, if I sell them at 15 cents, that's not a bad return.
No, that'd be a pretty good return. I would say this: I think every market maker, every professional trader is doing exactly the same analysis you are, and so the convexity of that move is built into that option pricing. But I think the point you're making, or the point I would take from what you've said, is these are intended to be tactical trades. These are intended to be tactical vehicles. I punched up what is it? It's a 10-year. I'm sorry. Yep. 10-year chart for VXX, and the high is over 14,000. So obviously, these products are going to erode away, and that's just the way they work. They're intended to erode away. There's a reason that options cost more over time than they're worth.
Yeah,
and that's fine.
What the split adjusted?
Mean by being cheated.
Yeah, what the split adjusted price of VXX's initial listing date price is? You'll get a kick out of this.
I think it's about 6,000.
It's 107,000 split adjusted. It's a little under $108,000 split adjusted.
You're right. I wasn't going back far.
Yeah, you missed. You didn't go back quite far enough. It's awful. And if you want to see even worse, look at UVXY, which split adjusted is listed at $35 million.
I think it's what, like 97 cent, 97% value erosion on this product over time, something along those lines. Impressive percentage. Go ahead, Scott.
Well, I have the split adjusted all-time high for VXX I have is 122,880. But again, that's to be expected. Listen, options cost more than they're worth over time. That's fine. I mean, that's something you can take advantage of, maybe by selling options sensibly. I'm a fan of selling covered calls. I'm a fan of selling cash secured puts to buy stock at a discount. But the analogy I always make is that your homeowner's insurance costs you more over time than the pure insurance value is worth. And that's the way it has to work. State Farm has to pay their employees. They have to pay for the lights. They have to pay the occasional claim. And they also have to generate a little bit of profit. And that's why options and insurance cost more over time than they're worth. Doesn't mean that it's not a good deal to buy it. You have to own homeowners insurance. And every once in a while, it also makes sense to buy some options.
I want to keep rolling on this, but we have to get our listeners on here as well. So without further ado, let's open up a little bit of our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Vol voicemail. This is the portion of the show where you guys get to weigh in. All sorts of interesting queries coming in this week. Let's see here. Eroding skew. Scott, here's a fun one. It's kind of up your alley. This comes from B Bort. They ask, quite simply, why does skew exist in VIX options? I know you're a big fan of skew, obviously, with the SkewDex. This is kind of a theoretical issue we've kind of debated on the show a long time ago. We haven't really discussed this in a while because obviously on a pure theoretical level, you really shouldn't. So I'm curious, Scott, what do you have to say for our friend? I'll give you first crack here, B Bort. Why is there a skew in VIX options?
Great question, and it can get geeky fast. I'll try and keep it from getting geeky at all. But you're right. Skew should not exist, given the assumptions inherent in option pricing. Skew should not exist. Why does skew exist? It exists because the assumptions that options traders use are wrong. They're simply wrong. And the one that I like to cite is one of the assumptions that's inherent in option trading is that the underlying prices will move continuously, meaning in tiny little increments, and you'll always be able to execute however much you want at these tiny little increments. And anybody who has seen, for example, Nordstrom stock, which opened up gapped much, much, much higher, knows that stocks do not move, prices do not move continuously. And so skew is one way to account for the fact that that assumption is not valid. And as a political or as a historical aside, skew in the S&P space did not exist before 1987. And after the 1987 crash, traders realized, wow, markets can move faster than I ever imagined. So let's build in a little skew as kind of a margin of safety.
Yeah, you also have the issue of kind of supply and demand, Scott, where basically the whole world is long, and now that people that more sophisticated funds are actually hedging, there is we do have real issues with, I think, supply and demand in terms of everybody in the world wants to buy put and sell call, right? And that is another, I think, piece of this skew puzzle. VIX being the opposite of that, right? If you look at the curve of VIX, it's basically just an upside down S&P curve with a little more more price to how VIX moves, but that is all. A lot of that is also demand based.
You're absolutely right. Absolutely right. And so the way I look at it is this: we're talking about an asset. And all assets have have price shocks. All assets have price shocks. You will see skew go higher in the direction of the price shock. And this, for example, there is generally upward skew, that is call skew, in the crude oil and gold space, because if there is a shock, those shocks tend to be higher. There is put skew in the S&P space, because if there is a shock in the S&P space, it tends to be to the downside. Upside is, for a long time, was the case, for example, in treasuries. So that's why the skew is built the way it is. But you also make a great point about supply and demand in the S&P space. People want to be owners of puts. They want to sell covered calls. And also in the VIX space, the skew is to the upside, because if there's a price shock in VIX, it's going to be to the upside.
Yeah, this is a good question. We used to talk about this in the early days of the show. We haven't brought it back up in a while, but I'm glad our listener kind of did. It kind of does show the separation of the theory versus the practical once these theoretical products meet the actual practical world with supply and demand and all the other fun things that exist in the actual options market. Interesting things happen, like skew popping up in a place like VIX options where maybe it shouldn't be. Let's see here. We got time for it. Let's squeeze in one more here. You guys keep the questions coming. We'll have an all Q&A episode one of these days. Don't worry. Lisl asking us here. This goes back to your favorite puts here, Mark. I looked at the VXX Jan 10 puts and then ended up moving up the chain to the 20s, all the way up to the 20s. That's hefty. She goes on to write, I got some ranging from 65 cents to 82 cents, so a little bit more, but I think my odds are better. Although I could get 60 to 80 of the other puts for every one of these. Do you hate? No, we're not haters here on the show, Lisl. You do what you think is best. If you like the 20s, go for the 20s. Go for that. If you're not into dropping on the penny. And we mentioned before, we had a listener write in last week talking about the costs for a retail person to kind of pick up a large number of those penny puts. The brokers aren't giving you any break on that. I think someone said for buy a 200 lot on E-Trade, the trade cost $200 and the commissions were $1.60. So, factor that into your math as well. So if you're going to do that, maybe there's a little bit of a commission math driving you north as well. I don't know, Mr. Meatball, you're the put gobbler here. You like these Jan 20 puts?
If I wasn't getting paid to buy those, I would not do the trade. If you're actually playing commission, then buying these puts is the silliest thing. Is not a great trade. And I do like the 20s or the 25s or whatever. I mean, in our fund, I currently own about 1,500 of the 25s as well. So, I'm not. I like her. I like this person's idea. And no, unless you're getting paid to buy those, then don't buy a penny option. That would be my advice.
Good sense for all. Yeah, I'm a fan of both of those strikes, the 20s and the 25s. I like them both. Speaking of liking things, let's see how much we like VIX, because it's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball, the most challenging portion of the program where we attempt to divine what the volatility gods hold in store for us for the coming week. A challenge. Anyone who's ever been on the show is always like, that last part really messed me up. So we get to do it every week, which is fun. Last week, we all gathered together. It was myself, Dr. VIX, a.k.a. Russell Rhodes, and the Rock Lobster, I believe. And let's see. I was not feeling all this upside we saw in VIX. I thought I was going to erode but a bit down to 12 and a quarter. As we're coming in right now to the end of the show, it's right almost exactly at 13 even in the VIX Cash. So I was a wee bit off. Mr. Meatball was feeling, or Rock Lobster was feeling far to the downside. 11.01 was his prediction. So he was several handles off. And guess who won? Almost exactly. Surprisingly, he hasn't been on in forever. Comes on and knocks it out of the park. Dr. VIX got on 13.05. So almost, that's within our 0.10, which is effectively a bullseye in VIX land. So he gets the winner chicken. He hasn't won in a long time, so it's good for him. He used to always be the degenerate upside buyer in VIX land. Of course, he's not on this week, so you can't celebrate his victory. Instead, we'll extend that to our guest this week. Before we do that, we let our audience play along this week too. It just expired right before crystal ball time, so nobody could cheat. We asked you guys, quite frankly, why don't you play along with us this week? What is your guess for the crystal ball segment? Where will VIX be at exactly the end of showtime, right around 1 p.m. Central? We made it easier for you, though. We gave you ranges instead of having predict exactly like us. So we gave you 12.5 to 12.99 was one range, 13 to 13.49 was second range, 13.5 to 13.99 was the third, and 14 to 14.5 was the fourth. The guesses were all over the place. You guys ended up actually splitting, and I guess technically both of these are kind of right because it went out right at around 13 for poll time. 30% saying 12.5 to 12.99, and 30% also saying 13 to 13.44. I never thought that 13 even level would be so important, but it is. So technically, I'll give a win to both of you guys. I'll be very nice. So all of you, the 60% who voted for those two, you get wins. 24% looking a little bit higher, 14 to 14.5, and 13.5 to 13.99, 16%. So you folks, you get nothing. But the rest of you get a celebrated pat on the back. I bought you some time, Scott. I'll allow you the dubious honor of going first, sir. This time next week, the end of the show, where do you think VIX Cash will be, sir?
No. We're going to do VolDex. I'm going to do VolDex. VolDex, ticker VOLI.
We'll do both. How about this? We do both.
Exactly a week from today, we'll be at 8.99, 8.99.
We'll do both. That's great.
Okay, we'll do both. How about that? We'll do both because I need to go look up my VolDex now. But do you have a guess for VIX Cash too?
I have no idea what you're talking about.
He's never heard of the VIX.
Never heard of such things.
Never heard of what?
Never heard of
So let me actually mark
$8.99, huh?
$8.99 for VolDex. I'm going to go look up my range of VolDex for a second. So Mark, I give you dubious honor of going second.
Yes. So the low for the year in VolDex is about 6.5. And the recent low was 775. It looks like about 775. So I'm going to scoop under Mr. Nations, and I'm going to say 8.25 on VolDex. And on the VIX, I'm going to say we're going to be 1195. How about that?
8 1/4 and 11.95 here. Scott giving me some extra homework here. So right now, coming into the end of the show, VolDex right around 933, off nearly half a handle, or for you percent-to-percent fans, about 5%. So 933 coming into this, 825, 899 for Scott. Both good prognostications here. And of course, we're at about 13 even in the VIX Cash. I like downside as well, but we have a lot of that space been carved out. I hate to be the guy to do this. I don't think we're going to break an 8 handle next week. That would be aggressive. But then, shall we see in the VolDex? So I'm going to be that guy. I'm going to say 870. I hate to do that, but c'est la vie. You guys left me no choice. That's what I get for going last. And then VIX Cash land. I do feel the bloom coming off the rose out there. So we're at about 13, a little bit shy of that right now, 1296 here. I think we're going to come off a bit as well. But I kind of like my number from last week. I don't usually do this, but I'm going to keep it around that level. I'm a little bit lower. I'm going to say 12.25. All right, there we go, listeners. Those are our prognostications for next week when it comes to volatility views. That's also the end of the show, unfortunately. Funny how fast an hour goes by when we're talking all things volatility. But Scott, as our guest, for putting up with us all show, answering some questions, all the fun stuff that you did, we want to thank you. And again, you mentioned where listeners can go and they want to follow you on Twitter. It's at Scott Nations over there on Twitter. And it's just nations.com for which is a great URL if you want to learn more about the products. Anything else, Scott, you want to plug before we go? Now is the time, sir.
It's been great talking to you guys. Thanks so much for having me on.
And I'm glad you worked a little VolDex into the crystal ball as well, mixing it up. That's a nice little curveball. I like that. You threw me one. I wasn't ready for it, but that's what makes it fun. I get to learn a new index now and track it, which is always fun, which I think was your insidious goal all along, sir. So well done. And Mr. Meatball, same question for you, sir. What is cooking in the land of Carmen Line and Option Pit?
Hey, if you're looking for a smarter way to get exposure to the S&P 500 and you're a qualified investor, you can reach out to me, Mark at Carmen Line Capital, and I'd love to talk to you. If you're interested in learning how to trade options like a professional, then optionpit.com. There you have it.
There you have it. Check it out, optionpit.com. If you want, or maybe you too want to buy some of those puts, then you call up Mark and take advantage of his pricing on those. So you don't have to pay, almost $200 from E-Trade to buy 200 of those, which is impressive. All right, on behalf of Scott and Mark, and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing to the show. Scott, we'll have to get you back on more frequently than once every 4 years, particularly when we see, looking forward, when these products get listed, we'll definitely have to bring you back on to check in on that. So we'll do that, and we'll see you next time for more Volatility Views.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.